The 2008 financial crisis began with cheap credit and lax lending standards that fueled a housing bubble. When the bubble burst, the banks were left holding trillions of dollars of worthless investments in subprime mortgages. The Great Recession that followed cost many of their jobs, their savings, and their homes. The financial crisis was primarily caused by deregulation in the financial industry. The 2008 financial crisis was the worst economic disaster since the Great Depression of 1929. It occurred despite the efforts of the Federal Reserve and the U.S. Department of the Treasury. The crisis led to the Great Recession, where housing prices dropped more than the price plunged during the Great Depression. The financial crisis took its toll on individuals and institutions around the globe, with millions of Americans being deeply impacted. Financial institutions started to sink, many were absorbed by larger companies, and the U.S. government was forced to offer bailouts to keep many institutions afloat. The catalyst for the 2008 financial crisis were falling U.S. house prices and a rising number of borrowers unable to pay their loans on time. The biggest culprit during all of this was the lenders. That's because they were responsible for creating the problems. After all, these lenders were the ones who advanced the loans to people with poor credit and high risk of default. Three effects from the 2008 housing crisis were lower fertility rates, historically high levels of student debt, and diminished job prospects among young adults. This was expected to linger for many years after the 2008 crisis. The 2008 Great Recession had wide-ranging economic effects on Americans of all ages, but older people were relatively insulted from the prolonged economic downturn. Adults ages 65 and older were more likely to be retired and thus less likely to experience an impact of a job loss. They were more likely to own their homes outright, so they were less likely to fall behind on payments or lose their homes to foreclosure. The industries that were most affected by the 2008 housing crisis were retail, restaurants, travel, hospitality, service, real estate, and manufacturing, all because they relied on customer relations. Some shocking stats to come out of the 2008 recession were $144.5 billion moved from money markets to treasury bonds, $439.6 billion buying bank and car stocks, and unemployment was still above 9% in 2010. The U.S. gross domestic product fell by 4.3% during this time. The outcome that came out of the 2008 recession was 8.8 million jobs were lost, unemployment spiked by 10%, and 8 million homes were foreclosed.